We just got last month's job report, and what it said is that our job market is stronger than ever, which is bad news for the Federal Reserve Bank and their fight on inflation. This morning, when the jobs data came out, it said that unemployment has fallen to 3.4%, which is the lowest unemployment levels that we have seen outside of the last number of months since 1969. 54 years since we have seen unemployment levels this low. Now, on one hand, this is great news for the economy. People got jobs. At least people have some sort of jobs. Not everyone's happy with the job that they have, but people have jobs. But on the Federal Reserve Bank side, on the inflation, it's not so good because the Federal Reserve Bank wants to cool down demand because they want people to stop buying things. And if people stop buying things, that will cause the price of things to stop growing so quickly, which means if you want people to stop buying things, you need people to stop having money to buy things. And how do you stop having money to buy things? Well, you don't have as many jobs. And this is why for the last number of months, the Federal Reserve Bank has said that they want unemployment levels to rise. They want people to lose their jobs. Now, of course, they can't go out and say publicly that we need people to lose their jobs and we need companies to go bankrupt. They say it in more politically correct terms. What they say is that the job market is too tight and we need to see the job market loosen a little bit. What does that mean? It means that they need unemployment levels to go up. Earlier this year, in 2023, the Federal Reserve Bank put out their annual review and report of the economy and their predictions. And what they said was by the end of 2023, they anticipate that unemployment will rise to around 4.5%. Again, we're at 3.4% today. If that happens, that means just over 2 million Americans would lose their jobs between now and the end of the year. Now, does this mean that the Federal Reserve Bank wants people to lose their jobs? Well, no. What they want is inflation to come down. And one of the byproducts of inflation coming down is unemployment going up. The problem is the Federal Reserve Bank has been working to increase interest rates. They've increased interest rates 10 times consecutively, and inflation is still high, and the economy is starting to hurt. Now, unemployment, jobs is a lagging indicator, meaning it takes more time to see pain in the jobs market. But this is where the Federal Reserve Bank, before their next meeting, is going to be looking at data. The Fed has made it very clear in the last report that they're going to base their future rate hikes, or if we have future rate hikes, based off of data. And this is the first point of data that they're going to look at, which is jobs. And if the job market is very strong, like what we're seeing right now, we have the lowest unemployment levels we've seen in decades, that gives the Fed more fuel to continue raising interest rates. The next piece of data that the Federal Reserve Bank is going to look at is inflation. And on May 10th, we are going to get our next CPI report, our next inflation report. And the reason why the next inflation report is so important is because over the last number of weeks and months, we've seen a few things happen which could impact inflation. And this goes particularly to interest rates and the housing market and oil. Now, we've been covering all of this in Market Briefs, my free financial newsletter, and we're going to keep you updated on what happens with CPI when it comes. But if you haven't joined Market Briefs yet, I highly recommend you do so because it's a free and easy way for you to stay up to date on what's happening, when it's happening. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs, I got the link to how you can join down in the description below. But over the last number of months, we've seen home prices start to flip upwards. Because what we saw happen is starting late 2022, as interest rates started to rise, mortgage rates really went up, and people stopped buying homes because homes started to become less and less affordable. So that made the demand for housing go down, which was great news for inflation because the housing market, while it's not directly on the CPI report, housing has a huge component in CPI. It makes up about 44% of our total inflation report through indirect housing numbers. So when housing values go up, that indirectly affects CPI. And so for a number of months, consecutively, we saw the demand for housing go down because people didn't want to pay the higher mortgage rates. But then this year, in the last number of months, what we saw happen was we saw a little dip in mortgage rates. And that then caused a lot of people to want to go out and start buying homes again. And slowly, what happened, which I was talking about here again and again and again, was if people are buying homes, that could push home prices higher again, because home prices, just like anything else, depends on supply and demand. When you have 50 people bidding for one home, the price of the home is going to sell for above asking, and home prices are going to rise. And that's kind of what we saw happening. Maybe not to the same extent as 2021, but we started to see a lot of demand in the housing market again. And just in the last couple of days, what we saw was that home prices started to rise. And now we're starting to see home prices rise again, or we have based on past data, and that's going to be shown on this inflation number. And so what we don't know is how much these higher home prices are going to impact inflation, along with the higher oil prices that we saw over the last number of weeks, which also make things more expensive. So if inflation comes out higher than expected, that would be another pressure on the Federal Reserve Bank to need to raise interest rates again. But then when you start tying it all together, we also have the economic impacts. And this is where now the Federal Reserve Bank is starting to keep a stronger eye on what's going on in the economy, especially after the recent bank failures. Obviously, we had Silicon Valley Bank, we had Signature Bank, but then most recently, First Republic Bank failed. And now we have a couple other banks like PacWest who are really close or on the verge of potentially failing or having another fire sale. So now the Federal Reserve Bank has to balance inflation with the economy, which interestingly was never on their radar before, because previously the Federal Reserve Bank kept saying that the economic issues are not a part of their mandate. It's not a part of their job. What they need to do is they need to control price stability and they need to control maximum employment, but people got jobs. So they don't need to care about the banking sector because they have two mandates. Our Federal Reserve Bank in the United States has a two-pronged rule. They need to maximize employment and they need to monitor inflation. That's it. But now they're starting to look at things like the banking sector. They're starting to look at things like layoffs. They're starting to look at see which companies are starting to hurt. And they're looking at the GDP, because the last economic report, our GDP report, said that our economy is growing slower than expected. Last quarter, our economy grew by 1.1%, which is significantly lower than what was expected. So now the Federal Reserve Bank has to take all of this data in their next meeting, which is still a number of weeks away, but they have to take all this data and then they're going to have to make decisions. And now you can start to see why every month the Fed's decisions are becoming more and more crucial, because we're seeing inflation come down, but it's still sticky. It's still so high. At the same time, we're now really starting to see more pain in the economy. Unemployment is a lagging indicator, but unemployment is still extremely low. But we're seeing more and more pain in the economy. We're seeing businesses report slowing sales. We're seeing retailers say that consumers are struggling spending money. Why are consumers struggling spending money? Because, well, inflation is so high. When you have to pay more money for your rent, for your groceries, for a vacation, you have less money to go to Macy's and shop. It's natural. But if you have less money to shop at Macy's is going to make less money. That's how our economic system works. And we also have now tightening lending standards, because, well, banks are having to be much more cautious. We've been seeing banks really get into a lot of hot water recently because of the banking crisis. People are pulling their money out of certain banks and moving their money into different banks. So we're seeing a big shakeup in that banking sector. Not to mention, companies are being forced to be much more productive. And if we look historically, anytime we've seen an economic slowdown, the first sector to get hurt of industries are businesses that rely on advertising dollars. Now, in this economic slowdown, the first industry that got hurt were businesses that relied on free money. All the startups, all the tech companies, all the companies that have been relying on the cheap, free, and easy debt or venture capital. When that money started to go away, those companies immediately started to get hurt. But then now what we're starting to see happen are the advertiser-supported businesses start to get hurt. We've been hearing more and more bankruptcies or potential bankruptcies and layoffs in that media side of the business. Now, previously this would be like newspaper companies. Now a lot of this is digital media. Like we saw BuzzFeed News declare bankruptcy. Vice Media or News is on the verge of bankruptcy. And in addition to that, a lot of the tech companies that rely on advertisements are also starting to feel the pinch. Now, I can tell you from experience, because most of my companies, Minority Mindset, Briefs Media, we rely on outside advertisements. And advertisers are not spending money the way that they did 2 years ago or even a year ago. And part of the reason for that is because they don't have access to the same money. Now, I can tell you from experience that, like on YouTube, for example, fintech companies were one of the largest paying sponsors and advertisers. Like if you were watching a YouTube video 12 to 18 months ago, you were going to get a lot or bombarded with fintech ads. Companies, brokerages, investment firms, robo-advisors, all these companies, because they were getting such high valuations, they were able to borrow so much money and spend a lot, which meant if you were a publisher, a media company, you were making good money. And now we're starting to really see that shift. And now the question is, will this continue? Because if the Fed continues to keep interest rates high, that's going to put more pressure, not just on banks, but on businesses. And the saying is, when the tide goes out, you see who's been swimming naked. Well, if interest rates keep going higher and stay high, we are going to see over the next 12 to 24 months who's really been swimming naked. And that's going to put a lot of pressure on the economy, especially on the people and businesses who are not prepared. So this is the opportunity now for you to, one, understand what's happening, be prepared, and then find the opportunities. If you want to stay up to date on what's happening, Mark Briefs will help you do that. But this is where you want to get financially educated, because the reality is, well, downturns also create opportunities, but you have to be able to capitalize on the opportunities, which means you have to be educated and have that money put aside.